Hello everybody, my name is Alesh Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. I wanted to share with you my approach for buying and making money off individual stocks. Please note this approach isn't really appropriate for exchange traded funds or mutual funds, which tend to be long-term buy and holds. So, for each individual stock purchase, you need to make a decision. Is this going to be an investment or is this going to be a trade? So let's look at the investing side first. It's a long-term investment because you believe that this is a good company for the long term that will keep going up and doing well for years. So what's the strategy? If the company goes down in price, you would be buying more as long as you believe the reasons that you bought it for initially in the first place, because the company's on sale at that point. If the price goes up, you can choose a couple of things. You can start selling once it passes fair value and keep selling as it keeps going up. Or other people use a strategy where they sell a third after 100% upturn, and then another third after another 100% gain. So at that point, you've got your money out, and now you're playing with the house's money, as the saying goes. So that's for the investment, the long-term investment. So now let's take a look at the trade side. It's a short-term purchase, usually waiting for something to happen. For example, you're expecting the company to get bought, the pipeline to be approved, etc. The strategy here is that if it goes down, let's say 20%, and you can certainly set that number for yourself, then have sell orders or trailing sales orders in place to minimize your losses. Because whatever it is that you were waiting for didn't happen and you were wrong, and you just need to accept that and get out because it's just going to get worse. On the other hand, if it goes up, you would want to start selling because, quote unquote, no one ever lost money taking profits. And a lot of the traders are going to be out by the time the stock doubles. The number one rule with these strategies is never, ever, ever turn a trade into an investment. For a trade, be dispassionate about getting out. Our need to be right causes us to double down and put more money into a loser to generally lose even more money. People hate being wrong, and as it starts going down, they really, really want to believe that it's going to turn back up, and in order to make it more profitable when it does turn back up, they put more money in, and then they just end up losing that money. Another good strategy is to be able to explain in simple terms to a friend, coworker, or even a child why this is a good investment or trade. Make sure that your purchase has some sort of a story behind it. In the way of additional background, let's talk about some drivers of stock price. So number one, earnings or profits a company makes and is expected to make are definitely a fundamental driver of the stock price. Next, we have quarterly reports where analysts give estimates and expectations ahead of the reports, and the company then tries to beat them. Since the price was set by and to the expectations of the analyst estimates, if you beat the expectations, the price should go up. If the company doesn't beat the expectations during the quarterly reports, price goes down. Another driver is how the company distributes its earnings to its shareholders in dividends. Companies that grow their dividends especially are strong, and their price should go up over time. Next, we have various macro events, politics, overall market, and the overall economy. And lastly, smaller companies have a tendency to be more volatile, both up and down. So if the company had a good quarter, if it's a small company, it'll be up 30, 40%. If it had a bad quarter, it'll be down by 50%. A big company that misses its numbers is going to go down a couple of percentage points. If it makes its numbers, it'll either do very little or go up a couple of percent. It's bigger ships take longer to churn, I think, is the basic idea. Let me also say that if you don't enjoy the analysis, maneuvering, and checking on individual stocks, the best approach is just to buy an index fund, whether as an ETF or a mutual fund. Another suggestion I would have is for you to diversify your investments, own different sectors, and using ETFs, you can own different parts of the world. You won't hit a home run as with an individual stock, but you also won't strike out. So if you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.